All right, we're live, just waiting for a few people to show up, getting ready. And one, two, three. Hey there, I'm Mitch Goldberg. Thank you for joining me. This is my live stream every Monday through Thursday at 4:30 p.m. It's your post-market show. We talk about the stock market news of the day that can affect you, the markets, affects you financially. We talk about personal finance, planning, and all sorts of money topics. It's about helping you take control of your money. It's about giving you the tools, techniques, tips, and tricks so that you don't make wrong decisions and hopefully consistently make right decisions. So that's why I call the show Be the Boss of Your Money. What did we learn from this big rebound in the last 2 days, two biggest days of the year? Of course, they were followed by some of the biggest down days of the year. So we're going to talk about this. What did you learn? What did you do differently? Were you um, were you affected by the market route? Do you think that the market route is over and everything that's down is going to go right back up to new highs? Do you get overly excited when stocks rebound like this? Did you get overly down when stocks were tanking the few days before this week, last week, and the Friday of a week and a half ago? So that's what we're going to talk about because we need to moderate things, slow your roll, and make sure you have a strategy. So let's roll the intro. And here we go. It's going to be good. All right, and we are back. So, do we call this the post Omicron rally? Do I have to, can I get rid of this mask, that I wear all the time? We'll see. Remember, Delta is still the dominant strain. The scary thing about Omicron was, oh no, there's something even more contagious than the extremely contagious Delta. Yes, but it turns out it's from what we know now, and things could change, but from what we know now, you know, the Omicron is not as serious of a disease. It seems like Delta merged with the common cold to become more infectious, but like the common cold, uh, it won't affect you like other COVID strains like Delta. So we'll see. In any event, it gave the market a reason to rally, just like it gave the market a reason to retreat. So let's go back a few steps, okay? The Friday after Thanksgiving, the Dow plunged 905 points. It's a pretty big down day by any stretch, even with a Dow at, 35, 36,000. Okay. 900 points is still a big deal. I think it hit the skids, not necessarily because of Omicron. There was some, there's always that last straw that breaks the camel's back, right? Nothing against camels. So Omicron gets credit for that, but I think we had the exact right setup for a down market because of sky high valuations, high multiples to sales, high multiples to earnings in the stock market generally. Interest rates were starting to tick up a little bit. Interest rates maybe were starting to become more competitive with dividend payouts, for example, from stocks. But more importantly, you have Jerome Powell, who's chairman of the Federal Reserve, who said we are looking to accelerate the taper. That means the Fed was going to take about 8 months to end its bond buying program, which floods the financial system of the U.S. with liquidity. And now it looks like they're going to maybe cut that time by half or even a third. And that means the Fed gets interest rates sooner. And this is because of general economic strength. And this is because of, what's been this year pretty high inflation. I mean, if we have to pick one word of the year in financial markets, it's definitely inflation. So Jerome Powell has come out and said, "Yeah, we see inflation being persistent, not necessarily transitory. We're going to retire that word." That's what he said. He says, "I think it's time we retire the word transitory," and it spooked people because the Fed is now hawkish. They're now fighting inflation instead of fighting economic weakness and fighting a pandemic and fighting for more employment. Now they're really just doing what they're supposed to be doing, fighting inflation. So that's a sea change from what we've been watching with regard to the stock market. And I think that's really what took us down. And it took down the most overpriced stocks there are. Now, let's talk about overpriced. I just want to give you some background because this is a lot of the stuff we're talking about is a matter of opinion. I could say something's overpriced, and you could say, how could you say that? They've got all kinds of growth coming up. They're going to do this, they're going to do that, they're going to change the world. It's not overpriced. You're just looking at it wrong. So let's talk about that. Overpriced means stocks that have gone up a tremendous amount. The biggest winners of this year, or to a large extent, are companies that either are losing money or make very little money. Those are the biggest winners of the year, the real aggressive, speculative areas. And that's what I mean by overpriced stocks. And those are the ones that got crushed. They didn't just get crushed in the last week and a half, they've already been going down. But I think investors' eyes were opened up to see how bad a stock like Zoom or, there's so many, we talk about them every day, DoorDash, pandemic related tech stocks, stocks that let you work from home or stay at home during the pandemic. And these stocks they were obliterated. And my point has been that these stocks are down so far for investors from their highs. I'm talking about Robinhood, Coinbase, so many names. The thought of these stocks going back to where they were, to their old highs. I mean, some of these stocks are down 75%, so they'd have to go up 400 or 500% to get back to their highs. I think for most of these stocks, it's a pipe dream. And a lot of, you might think, oh, Mitch, you've been negative for the last week. All week, you've just been so negative. No, I'm not negative. I'm pretty optimistic on the stock market. I'm not out here just selling every stock I have. So we're going to talk about that. It's those particular areas, though, that I think are the pandemic, the meme stocks. Okay, I don't look at those stocks as opportunities. I look at those stocks as permanent losses for the people who chased performance. There could be one diamond in the rough, but the odds of you and I picking the one or two stocks that recover and go on to new highs is probably pretty low. I mean, you could take a shot on an Nvidia, you could take a shot on an Amazon, and that, I think you'll be right. But I don't really have the same confidence for a stock like a Zoom or Ring Central or what have you. Okay, stocks that have just been obliterated, and a lot of these stocks are still too high. They're still trading at crazy high multiples, just not as crazy of a high multiple as they were a couple of weeks ago. All right, so I'm not being negative. I'm not saying I'm not being negative. I consistently said stocks over time is a vehicle in which you can earn a return above and beyond inflation and grow your wealth over time, as long as you give yourself a lot of time to moderate and average, to average out the volatility, the big ups and downs that the stock market will have over the near term. You know what I say is the difference between gambling and investing? Gambling means that when you gamble, the longer you sit at the table, the lower your odds are. But when you're investing, the longer you sit at the table, the higher your odds are of growth. Okay. So then let's get into the difference between risk and volatility. Volatility is the ups and downs of the stock market when your goals are far into the future. Okay. Risk, risk, on the other hand, is the ups and downs of the stock market when your goals, when your financial goals are in the very near future. Because then the risk is the market goes down and then you need your money and you're forced to sell into a down market and take losses. And that makes it harder to recover with whatever money you still have left in the market. You get that? So we talk about these concepts a lot here, and I think they're important concepts. Okay. Now, while you're watching, if you have any questions, you just want to say hello. I see a few hellos out there already. Thank you. I'm going to acknowledge those on the screen in a second. Hit me up in the comments. Words of wisdom, words of encouragement are always appreciated. And again, questions in the comments. First, we have my old pal, Andrew. Mitch, hope you're doing well. What are your thoughts on Apple and the uptick in price the last few weeks? Thanks. Well, let's just address that very quickly. Apple has two things. They have a lot of things going for them. I mean, so many things, but near term, Apple is thought of as a flight to safety. People would rather own Apple as a safety play than U.S. treasuries. The amount of cash they have, the amount of business they do, and the company has been a great corporate citizen, a great steward of their business, of their cash, of which they have a mega amount. Also, the company got an upgrade in their price today, I think to $200 per share. I forget which analyst did it. I just evades me at this moment. But Apple should also be able to move into the metaverse with a new pair of goggles and do all kinds of things in that arena. So they've got a lot of levers to pull. And, is there a limit to how big a company could be? Will they hit a $3 trillion market cap at this rate? Yeah, they'll hit it. They'll hit it pretty soon at this rate. It's probably 2.6, 2.8 trillion now. So that's my view. If you have a lot of Apple and you're up a lot in it and you're worried about it, they come up with a strategy. Maybe you want to sell a little bit, reinvest it into something else. Listen, nothing grows to the moon, although it does seem like Apple has. But that's where personal finance comes in. This is what puts the personal into personal finance. Okay. And we have one of the best, Rhonda Cooper. Thank you so much. I really appreciate you joining me. And you are always so supportive, Rhonda. Thank you very much. Thank you so much. I appreciate it. And I'm really, really great to have you. And thank you on the analogy part. Thank you very much. Great to see you. By the way, Rhonda is on LinkedIn. So go connect with Rhonda on LinkedIn. Okay. We have Josh out there as well. I know you're out there, Josh. I see right through the camera lens, right through your webcam, right into your office. I see you, man. You're wearing a red shirt today again. I really don't have any idea what color shirt you're wearing, but if you are wearing a red shirt, let me know in the comments because we might freak out a little bit over that. Like maybe he does see. Okay. Yeah. So where the heck were we? Okay. Overpriced stocks, blah, blah, blah. So the market was ripe for a sell-off. And we finally got it. We've had a pretty solid, steady year this year. So we were ready for a little bit of a scare. So the question here is, Josh says, black shirt, close black shirt. How does that come close, though, a black shirt? I mean, is black close? I mean, I happen to love red and black. Like, just to show you, my corporate colors are red and black. So I see that. Let me move it that way so you can see it. I love red and black. That's like my favorite color combo. I actually have red and black sweatshirts and stuff like that. Maybe I should put a logo on them. I've actually never put a logo on like clothing or shirts or what have you. Some people love doing that. I just never really thought it was worth my while, but maybe I have to change my mind. Okay. Anyway, good guess though. Good to see you, Josh. So what we have here is a severely down market, severely up market. Now, I think that you said this. You said I said close because I'm actually wearing a shirt today. That's good to know. TMI and call me for new swag and BCs. I don't know what BCs are, but I'm sure it's something to do with swag or tchotchkes or whatever. Tchotchkes. You know, I'm a New York Jewish guy when I say tchotchkes, right? Okay. Is that TMI for the live stream? No, I don't think so. We're all friends. So, So here's where we go. I, I I've been harping on this negative thing, and again, not negative in the market in the stock market, but the crazy price of the tech stocks went up so much, and I'm not including Apple and Amazon and Google in that area. I'm not including Meta, which is Facebook. I'm talking about those tried and true pandemic stocks like Peloton, for example, which went sky high because everybody's going to have to get a Peloton to work out because we're going to be locked down forever. And I didn't buy these because I thought it was ridiculous of how much they went up. And you could say, well, why don't you just buy them and take a trade? I'm not smart enough for that. Maybe they would have been a good trade. Maybe I would have gotten out at the right time. Maybe I would have held on to them. Maybe I would have said, I don't want to take the short-term taxes, the short-term capital gains tax hit. It's business cards. I got you, Josh. BC business cards. So that is a an issue. But I'm not here to be all things to all people. I I know what I can do, what I shouldn't do, what I can't do, what I have time for. And I don't want to get into the business of chasing the hot fad, the hot product, or the hot stock or hot sector of the day. I ignore all that crap. I don't even I don't get involved with it. I mean, I talk about it. It's interesting, but I talk about it in a way to educate you about it so that you don't make some hasty decision and set your retirement plan back by like 15 years because you made a hasty decision and loaded the boat on these stocks, and then they tanked, and you're wondering like, how the hell am I going to make that up? It took me years to accumulate this wealth, and I just blew it on these crappy stocks. What was I thinking? And then you'll say to yourself, I should have known that when we get back to the real world, get back to work, get back to going out, that a DoorDash or a Zoom or a Peloton would go down. I thought it was a fad that they went up. I really thought it was ridiculous, and that's why I didn't get into them. Um, I had one, but I bought it low, DocuSign. And when it got hit on Friday, and that was one that I really thought, because we're all using DocuSign and we're going to continue to use DocuSign after the pandemic. But after the stunning, oh my God, the staggering miss and the way that management missed numbers and did not recognize at all that the return back to work, to the office, things like that would crush their business. I do feel like I was misled by DocuSign management. I feel like that because they should have known this was happening. They should have been more forthcoming. And the slowdown that the big miss and the staggeringly low future guidance, they were actually suffering months ago, and they didn't say anything about it. So once that happened by like Monday morning, I was just I'm out of the stock. It's just, and it's not a matter of like, oh, can DocuSign bounce back though? I don't know. Maybe it'll go from 130 or 140 down to 100. I don't want to even play with it, and plus, I don't have trust in their management. There's no credibility. It was a tiny little position. I have my clients who have individual stocks typically have 20 plus stocks in their accounts, but I just there's no reason to hold it. I'll find something else to do, and since I still believe that the rotation into the reopening plays is still ongoing, and a lot of those stocks got hit also. There are other opportunities that I think are better. Okay, Rhonda says here we should never load the boat on one stock or type of stock ever. Truer words have never been said. It's like we should take a screenshot of this. I wonder if I could do a screenshot. Okay, hold on. Wait a minute. I didn't look good there. Let me take a screenshot. All right. I don't know if it took a screenshot or not, but hopefully it did. If it did, I'll get you a copy, an autographed copy. Yeah. All right. Thank you very much. So, let's take a look at how the market did overall and talk about strategy. Okay. Let's just cut to camera number 4, which is not cooperating. When I freeze up like that, it means something's not working. See that? I froze up. I froze up like that. We'll do it in a minute. Let's talk strategy. How did this affect you, this crazy market? Did you decide you need to sell stocks? Did you decide that 2 days ago or yesterday morning was the moment that you needed to lighten up? Uh, and are you buying back everything that you just sold a couple of days ago? Because if you're doing that, you're making a really bad mistake. And you're just proving to the world that, we as humans suck at timing the market. Now, there's some people who are really good at it who have the time, focus, and energy to do this stuff. Most people don't. And even if you got it right, you have to get it right again and again and again and again, because all it takes is getting it wrong once to destroy all the gains you've had from the last 100 times you got it right. Okay. So these are the things that are very important to discuss. So what's your strategy? I'm going to tell you this. I did almost nothing. The only thing I did is I got rid of a little bit of DocuSign. Again, because it's not so much the price of the stock, it's because management just lost it for me. There's no more credibility with management. So I dumped it. I'm not going to get back in. I'm not looking for bounce. And just to so you know, and this kind of sucks. My fourth camera for the screen isn't working, but I'm gonna give you a quick quote on DocuSign. DocuSign still, even with everything going down today in this big up market, and the Nasdaq was up over 2% today. Big rally. DocuSign was down $5 today, and it's down $1.20 after market trading. So I'm glad I got out. But if the stock goes up $10 or $20 in the next day or two, I'm still going to be glad I got out, because I'm not letting these daily gyrations, this hour to hour news, dictate to me, control me. It's not going to control me. Okay. Um, I think you're spot on with the pandemic stocks. Thank you very much, Phil. Thank you so much. And how are you doing, man? How's everything? We've got to talk and catch up. Merry Christmas to you and your family. Rhonda says, I'm flattered. I'm flattered and honored. Thank you. So you have to have a strategy before we have a tumultuous time. So my clients who view their accounts, I didn't change anything. I didn't run out of stocks or eat stock ETFs or stock mutual funds because the market went down. And I didn't run into anything and panic buy because the market went up. I did exactly what I do every single day. I'm pretty consistent in that way. I know what I own, what clients own. When I recommend a stock or invest in anything in a client's account, I'm on the line for it. It's not that I'm. Don't get me wrong. I'm not saying clients understand they're taking risks. I'm not saying I'm on the line for it. I owe them money if the stock goes down. And what I'm saying is it's my reputation. I care. I'm that's what I mean. I'm on the line for that. I've got to. I'm a steward of my client's capital. You could really screw someone's life up with bad financial advice. You could really f someone up. You've got to be careful. It's handling people's money is the greatest responsibility of someone's care you could have besides their actual physical safety. Think about that. All right. So I'm very consistent. We pick great companies. We create asset allocation models for client situations. And when I sell for a client, it's not necessarily because I think the market's too high. It's because they have goals coming up. They have the required minimum distributions coming up, or they have a need for a hefty financial obligation coming up, and we want to be ahead of that. It's not a matter of, maybe we should wait and see if the market goes up a little bit more before we take that $100,000 out of the market that you're going to need. That doesn't work. That's like irresponsible to play that. So these are the how we make our changes. I did nothing different when the market tanked over the last week and a half. I did nothing different when the market rebounded in the last 2 days because we have our accounts already set up the way we want them. That's pure and simple. I don't like to play this game of the market tanked. Let's jump in there and buy something because what if you bought DocuSign today and went down $5? You're like, how could that happen when the market went up so much? Believe it or not, there were Merck was one. There were quite a few stocks that were actually down today. It wasn't as green as you think in the screen. Let's see if this. I don't know why when I hit number 4. See this? This is we're on screen 3. So this is the over the left screen. You see? See? And I like this angle. I think it's a really cool angle to give people a behind the scene view. And then I could go to screen 2, which is like that. But screen 4 keeps freezing up, so I'm not even going to play with it. But these are the vagaries of live streaming, and you're sending an awful lot of information and bits through the internet. And from what I understand, Amazon Web Services is having major problems, causing problems for companies like Netflix and logistics companies all over the world because of some problem with Amazon Web Services. So I'm happy that I'm even live streaming today because sometimes when that happens, my live streams don't go. All right, so that's really about it. I'll sum it up. You need a strategy. And if the strategy is you're going to react to market movements, unless you're a professional day trader, that's probably not working well for you. What you need to do is figure out what kind of investor you are. Now, the market's gone up a lot the last year and a half. Were you an investor, but you were really just enjoying a bull market? Did you think you were really smart because the market went up and it validated intelligence that you really don't have? You just happen to be in the market at a good time. I'm not calling viewers unintelligent. This goes for me as well. I don't think I'm any smarter because my clients' accounts went up a lot in the last year and a half. I have clients who are suitable for equities, either through exchange traded funds, mutual funds, or stocks. And I have these clients in stocks because of their age, their time horizon, their risk tolerance, not because I thought they should be in stocks now and I thought they shouldn't be in stocks like, in February of 2020. That has nothing to do with it. But you need a strategy that dictates what you do when the market has massive volatility. My strategy is I don't do anything different. We invest for the long term. We pick and choose solid companies. Some clients want more dividends. Some clients want more growth. Some clients want more value. We go through what we need to do, and then we control what we control. We don't let market action dictate anything to us in terms of our actions and reactions because we're proactive. And then we control things like updating our wills, beneficiary designations, properly being, insured, looking at a goal and saying, hey, if you have X amount of money at X amount of interest, and it'll be worth X amount in 5 years, let's say, what does that mean now? Or how much you have to put away for your child's college education every month in order to be able to pay for college in, 15 or 16 or 18 years. These are the things that I spend a lot of time on. And I love to read and I know all about what's going on in the market, but I'm not letting market action dictate anything. I'm just not going to do that because it doesn't actually help anybody. And in the long term, stocks are going higher anyway. I have to say, in my opinion, but I'm sure you agree. All right. That's about it for today. And I thank you so much for joining me. It was a really good show. I cannot believe how fast the time went. And thank you. I really appreciate you sticking around.